Hi there, everybody. How you doing? This is Jeremy, and welcome here to FXIFY Pulse, the show where we help you trade smarter. So my name's Jeremy Wagner, and we are ready to get rolling here. Quite the movement going on in the market, and some of these moves we had anticipated in Tuesday's show. So if you had not seen us or watched us, the recording or live on Tuesday, make sure you go back and check that out afterwards. We'll go through and review some of what we discussed on Tuesday, but basically want to keep this ship moving forward. And before we move any further, we need to take a moment and take a look at this risk disclaimer. All right, welcome. And if this is your first time here, I want to welcome you as well. So as we go along, if we have any questions, go ahead and pop those into the chat box. Now, a little bit about myself here just for a moment. We will be taking a look at the market through the lens of Elliott Wave theory. If you are not familiar with Elliott Wave theory, that's completely okay. We'll still unpack the market, trying to use some of the simple terms, but every now and then I might throw out an Elliott Wave term that you may not be familiar with. So go ahead. If I do that, and if you're not familiar with something, go ahead and pop that into the chat box. So I want to make sure that you're comfortable and that you're able to pick up what I'm putting down. Okay. So what we're going to start off with, the headline for today is going to be gold. Now, if you recall on Tuesday, we had talked about a structure in gold, a pattern that was developing that, at least from Tuesday, was bullish. We walked through a live trade setup, talked about how that was analyzed, how to determine and figure out what your trade size might be relative to your account size. We went through all that on Monday's show. I tried to keep a lot of my drawings and such on my chart. I tried to keep them intact relative to what we had on Tuesday. I did add a couple of lines here to this chart, but this is pretty much the same. So now that we've had a couple of days of price action developing, let's dive right in here and pick up. Now, if you happen to miss the analysis from Tuesday, I'm going to go ahead and pop this out into the chat box, and you can watch that. That should be time-stamped from where we started talking about gold on Tuesday. So I'm not going to review everything from Tuesday. We're just going to pick up from where we are right now. We were anticipating a move up to these highs, and we had kind of identified these gray boxes as potential reversal spots. Okay, and it looks like gold wanted to split the difference. It went right in between them. So the trade we had set out there, we had set a target up here for this initial gray box. Tag that nicely. So now that we've got a couple of more days of price action under our belt, it does look like we can count this as I had originally set up. So, I'd originally thought wave 5 was going to terminate there. It looks like it extended slightly beyond that initial target. So what we're looking at here is a 1, 2, 3, 4, 5 bullish impulse. Now this is key to the long-term prospects for gold. All right, so we've had quite a long decline going way back here. Gold's been declining for the last several months. Now that we have started off a new trend with a bullish impulse, when you take, so there's 5 basic patterns within Elliott Wave theory. And in essence, what we're doing is we're analyzing the structure, we're stitching these patterns together, and they make up a larger structure, but there's basically 5 basic patterns to Elliott Wave theory. Now, when you look at all of those 5 patterns and all the combinations of patterns that can be arranged, there's only 2 patterns that start with a 5-wave structure. So here's a 5-wave structure that just kind of idealizes this. So of all the various combinations, there's only 2 structures that start off a new trend. So you could say we've been in a long downtrend, so we're starting off a new trend. So there's only 2 structures that start off with a 5-wave structure. There's 2 things that happen after that structure. Number one, you get a three wave or some type of corrective decline. And then number two, you tend to get another 5-wave structure of similar size or Fibonacci proportions to this guy. So, number one, 3-wave decline. And then after that, we tend to get another bullish structure, another bullish impulse that would be of similar size or Fibonacci proportions to this. And so far, how are we looking on this 3-wave decline? Well, it looks like we could have, an A, triangle B, and then C. So let me I'm going to add some more lines to the chart here. So we're going to take off some of these lines. This bullish key level here, by the way, that was with regards to Tuesday, saying that, hey, as long as we held above here for the next couple of days and we punched up to a new high, prices would need to hold above there. Well, now that we'd punched up to the new high, that bullish key level no longer applies to it. So because we've finished up this initial bullish structure, now we're going through a 3-wave decline. So the way that I think this 3-wave decline is shaping out is looking at a correction like this. All right, so there's a couple of tools that we can do to determine where we might be at. I'm going to start off with this Fibonacci extension tool. Basically, we're going to measure out the length of wave A. We're going to project it at the end of wave B. And then oftentimes wave C will have Fibonacci or equal wave relationship to wave A. And it turns out we are right on top of that right now. So right here is where wave C is 1/618 the length of wave A of the correction. So that's a common wave relationship. We're also going to take the Fibonacci retracement tool and we're going to apply it to this recent rally. So retracements measure adjacent waves. Okay, so we had a rally. So now we just want to see, okay, if this does a partial retracement, where might this partial retracement go to? And we've got, 236, 382, the 50% line, the 618, and the 786 out here. So the 618 is also very near where the Fibonacci extension is. So right here, we are beginning to develop, this may be a hot spot in a sense of if we can see if gold can put in a bullish reaction near this zone, possibly even begin to recover some of the losses for the day, then this may begin to relieve this pressure. This could set the stage for another bullish run. Now, it's not smooth seas. This doesn't mean that prices just start rocketing higher. That is one possibility. Prices could go ahead and take off from here. Prices could also continue to work itself lower. It's not 100%. We're not 100% sure that this is a completed bullish impulse. This could also be a double zigzag higher, and we could come down and retest these lows. So so we're never 100% sure on what's going on, but we're just deducing what the idealized look of some of these patterns are. And right now, this pattern looks to be a bullish pattern, and we're looking for a 3-wave correction. So there's a couple of things that could happen here, or at least a couple of higher probability things that I think could happen. Is I think we're going to see a reaction here pretty soon, and then it's going to start to work itself higher. What happens from here is where some of the models, the Elliott Wave models, begin to diverge. One model says it could just continue trucking higher, and then we get another rally. So this thing went from about 39.60 up to 41.60. So this went about 200 gold points. So we could get another rally of about 200 to 400 gold points higher. So that could take us up to 42.5, 44.5, possibly even higher levels. So that's what one model suggests. There's another model that says, you know what, we get a little bit of a relief rally, and then prices come back down and then press this 786 level and then begin its ascent. So it's not smooth seas ahead. There still could be some more rough patches coming. But here's what a couple of the models look like. And then there's also another model that just says, hey, we're just going to come down here to 786, and then rally from here. But we are starting to hit some of these hot spots where the market is going to tip its hand as to which one of these models is it favoring. And the first thing that we want to look for is we want to look for some bullish reactions here. So right now I'm on a 1-hour chart for gold. So for a bullish reaction to take place here, obviously we'd like to see some green candles. We'd also like to see this last red candle, get a pretty good retracement on it. So in essence, if gold were to work itself up above this green line right here, that would be a first step that says, okay, you know what? We may be heading up or relieving some of these oversold pressures that have developed. The big structure, or the big point to keep an eye on is going to be right here, this current day midpoint. What this is suggesting is that with this being a very large red candle, as long as we're pressuring the lower ends of this large red candle, there's just going to continue to be pressure to the downside. So I don't know if this is going to relieve itself. These oversold pressures today may take a couple of days to do so. I would not want to be short because we are in a hot spot. This is an area where a bullish reaction could take place. So being short here could work out. We could continue to see this move down to the 786, but it's a tough spot to be at. There is not a very good risk-reward ratio here in this spot, but the risk-reward ratio is beginning to skew back in our favor to the bullish side, because the chances are increasing that we may see at least a bullish reaction up here to 40.85. This happens to be where the current midday is. Also, we have previous resistance levels up here. So we may see a reaction up here over the next couple of days. From there, the models, again, begin to diverge. So that's what we're looking at for gold. If we were to place a trade, or would I place a trade in gold? I would say, if we were to grade our trades as A, B, C, meaning grade A is like the best, the best types of trades, I would say Tuesday's gold walkthrough was a grade A because we had a very defined risk to reward ratio. For today, it's definitely not a grade A. It may be a grade B, maybe a B plus. So it could be okay if you're looking at longer term trends. But I'd like to see a little more of a better bullish reaction before jumping into this instead of blindly going. So I tell you what we'll do. We're 13 minutes past the top of the hour. These are 1-hour candles. So let's check back on gold here towards the end of this session as we get towards the end of the hour. And if it's starting to put in, a pretty strong bullish green candle, we may look to do something then. Later today, if prices start getting up here, closer to this midday, or even above the 50% level, or even closer to this midday, and we start to see some bullish candles develop, we might consider something then. But it's just not a great time to do so right now. It'd be a little more like throwing darts at the dartboard with your eyes closed, because it'd be difficult to find a very tight risk reward ratio. If you were, I would place your risk down here below this low, because this is the conservative level where we are anticipating prices not to fall below. And so basically, even if you just, were to enter in near these current levels, you'd be looking at risk level down here. Even if you targeted, this recent high, it's about a 1 to 1.35 risk reward ratio. So, it's okay. It's better than 1 to 1, but there may be something better in store. If we had a way to tighten up that risk, that would help turn this from maybe a B into an A minus type of trade. Hey, Charlie, glad to see you here today. Thanks for joining. Hey there, Eamon. Good to see you as well. Welcome. All right, silver is going to have a similar type of pattern as what we're seeing on gold. So again, I tried to keep everything the same on silver. I added these trend lines out here. So silver, you know, what we were talking about on Tuesday was that it was a little bit less mature than gold, and that it may have had a little more upside to go. Basically, I think we were somewhere around here when we were doing the live stream on Tuesday, and we were anticipating, you know, a wave 3 to, you know, jolt to the upside, and then another little wave 4, and then another 5. So I'm going to go and update this now. This is where I would put it. I would put wave 3 up here, and this low here was wave 4. Get rid of that. And then we were looking for a wave 5 higher, so there's our wave 5. Now that we got 5 waves in place to the upside, we're looking for a 3-wave correction. Let me get rid of these as well. So it looks like we have our A, B. Let's see, could this be a triangle? Yeah, this could be a triangle, just like in gold. It looks like an A, B, and then C. So I'm going to use the Fibonacci retracement level from the beginning of the 5-wave move up to the end of the 5-wave move. Okay, so we're, ooh, man, tagged the 618 perfectly. Okay, got a nice long-legged doji here. That looks really, really nice. And then I want to measure, you know, this decline. So I'm going to measure the length of wave C relative to the wave A and see if there's some Fibonacci relationships showing up down there as well. Okay, let's see, A, B, C, D. So it'd be right here would be the end of B. And so, yeah, very similar to gold. We've got this hot spot right here. And gold came down, drafted a long wick to the, I'm sorry, this is silver, came down, drafted a long wick to the downside, right into this hot spot, rebounded higher. This is looking really good. This one's looking a little bit better than gold. On top of that, we've got this May 2026 trend line. It'd been holding prices down since May. Prices broke up above it. And then from Technical Analysis 101, once a resistance level is broken, sometimes prices will come back, retest the top side of it in this case, and you know, may begin to move higher. So we've got a few confluence levels developing right inside this long 1 hourly low here on silver. So this one is looking good. If I were to take a stab at if I had to choose between taking a stab at gold or silver right now, I would say silver is setting up a little better than gold. And, you know, we're not out of the woods yet because we're still below the current day's midpoint. So we're going to have some rough seas ahead, you know, probably into this zone. So if we were to go long now, we'd want to place risk just below this low, and you know, this zone's kind of getting in our way. So this is where you know, there's a couple of ways you can do it. You can just tackle this as it is with a smaller trade size, or you could wait for price to drift back down and retest a portion of this wick. Let me move this down to a 30-minute time frame. Retest a portion of this wick, you know, maybe down here about 57.25. Doesn't mean price will move there, but if it does, it would afford us a better risk-reward ratio in a sense that by the time we do get up into this gray box, we'd have a better risk-reward ratio. And at that point, we could manage the trade, maybe tighten the stop loss. So that if this does take off higher, we're participating in the trade. or we could choose to go ahead and close it out at this point. So we're kind of a little bit of no man's land. If you just eyeball the distance between this gray box and this lower gray box, we're right smack dab in the middle. So if prices can suppress a little bit to slightly lower levels, then that would afford us a better risk reward ratio. So it's looking better as far as this gray box, this lower gray box would be a stronger level of support. So if we can dig back into it, give it a retest, a handshake, that may afford us a long opportunity. If it can be successful in plowing above the top end of this box, so the top end of this box is right near where the current midday is. If it is successful in plowing above here in the next couple of days, then it's going to look much better to the upside. They'll have more smooth sailing after that. But there's going to be some rough patches and going along between here and there. So this comes back to your trading personality. You know, how do you handle these rough patches? Are you looking for grade A type of trading setups, or do you do a lot of little trades where maybe they're littler in trade sizes, and so therefore whether they win or lose, it means a little bit less to you because you're going to be taking 1,000 trades. It just kind of depends on your personality. I like to be a little more conservative and not be chasing after 100 trades. It becomes a lot to manage, and I like to try to keep things simple. So for me, I would want to sit tight a little bit. This is getting close to getting me excited about going long gold and silver. I think over the long run, prices may have reached a bottom. So if you're holding on to something for a longer term potential, then we're in that hot spot. Something's about to break here, either to the upside or the downside on gold and silver. Today's decline took us right into that zone. Okay, so we're going to check back on these here later in the hour and see how they're doing. Now I want to move over to FX, and then after we take a look at FX, we'll also go out and take a look at S&P 500 and Nasdaq. The reason I want to get to FX first, it's been on the move. Euro dollar. It's one of those that we talked about on Tuesday. Actually, Tuesday was the one I was planning on taking a bearish trade in euro dollar, but based off this equal wave pattern. So again, I tried to leave all the drawings out here from Tuesday, just to refresh your memory. Which, by the way, if you're interested in wanting to see these live streams more frequently, right now we're doing them every Tuesday and Thursday at this time. So if you want to see more frequent live streams out there, go ahead and give us a like, give us a thumbs up. That'll let us know, to go ahead and try to put more of these out there on the schedule. And I hope you are finding some value in this. Also, feel free to leave some feedback as to what you would like to see, markets or anything of that sort. Back to euro dollar. So we were looking at this, as being a bearish trade. We were talking about some struggles that may develop on Tuesday. We talked about some struggles that may develop near that 1400 mark. There was some wave relationships, previous support. Then we've also got this trend line as well. This trend line goes back to June 24th. And so it came down, was resting on top of that trend line a little bit, give us a little bit of a fake break higher. And then boom, now we hit. So this was the initial target we were looking at. To the downside, it's basically sliced through that like a hot knife through butter. And I think where euro dollar's headed next, let me move this out to an hourly chart here. I think where euro dollar is moving next is to retest this low. If you just take a look at this price action from the June 24 low, up here to the July 15 high. This is just sloppy, choppy, overlapping price action. That is very indicative of a counter trend bounce. And when you have a counter trend bounce, that increases the odds that we're going to see a retest of this low. Now, it's not going to become a straight line down there, right? It's going to zig and zag along the way. But as you can see from this high, movements to the downside have been relatively sharp. Movements to the upside have been sloppy and choppy. That's indicative that this trend is to the downside. We want to look for areas to sell. And, prices are on their way here. So it may find a little bit of support here near these current levels. We've got that wick out there that it's contending with right now. So we may see a little bit of a bounce. I would get really excited on euro dollar if it were to bounce and retest the bottom side of this trend line. I would get super excited about shorting euro dollar, up here near the bottom side of this trend line. I don't know if that's going to happen or not. Oops. Trying to get rid of some of these things here, clear up the chart. Don't know if that's going to happen, but there is bearish pressure here. So if it were to, even retrace a portion of this, if it were to come back up here to about 13, upper 1390s, because this trend line's up here at about 1405, maybe 1410 by the time it gets up there. If it's up in the 1390s, it may offer up an area of which to sell. That's where we have previous support that was broken, may act like new resistance. It's also our current midday price is up here. So even if we get to tomorrow and price starts to bounce over the next 24 hours, well, this would be the previous day mid. And so that could still offer up some resistance. So, but I think the next stop on this train would be looking for a retest of this 1325 low. So that suggests we may see some dollar strength. So it'd be euro dollar weakness means euro weakness, dollar strength. Now earlier today, the ECB came out and they announced they were going to be keeping rates steady. So don't know if that really played into, the movements of the euro dollar, but I know there are some folks that like keeping up on the news out there. Moving on to pound dollar. So this one, it's still moving in the direction that we anticipated on Tuesday. I was expecting a move to the downside, possibly down here to this 133 level. And we also were, talking about down here at 132. So again, I tried to keep all the markings from Tuesday out here to refresh our memories. So I have not changed much other than I added a few more labels and a few more markings up here. This sideways price action, I was not anticipating that. So now that we have it here, there's a couple of different things going on. First of all, prices are, wanting to stick inside this price channel. I thought it was going to break down below and be a little more aggressive to the downside. I was just 2 days early on it. I guess it's better being early than being late. This does have the look like a triangle pattern. Now, triangles are very important within Elliott Wave theory. A lot of times I'll get asked a question like, how do you know where to start to make a count? And sometimes you have to reverse engineer things in order to figure out where we may be at within the account. And a triangle is one of those patterns that we can use to reverse engineer, because a triangle is a very important marker within an Elliott Wave count. When you see a triangle, it suggests two things. Number one, prices are going to continue. That is just a consolidation, that prices were going to continue in the direction of the trend that was happening prior to the triangle. Okay, so that's number one. So you get prior to the triangle, you get down. You get triangle, then that means you get a downward breakout. Okay, so that's one thing that triangles indicate. A second thing that triangles indicate is that the trend that develops upon the breakout of the triangle, basically the triangle is the second to last wave of the entire sequence. And so if this is a triangle and then we're getting a breakdown, that means the triangle is the second to last wave of the sequence. And that means this breakdown is the last wave of the sequence. So if this is a triangle, then that means that we may be approaching a low that may produce a larger bounce than what I was originally thinking on Tuesday. So that's one way to look at it. Another thing is if this is a 1-2 and we're still developing a wave 3, this could be 1 of 3, 2 of 3. If this is 3 of 3, it would be aggressive to the downside. So let me move this over here. Basically this would just suggest that we were delayed a couple of days on what I thought was going to happen. So if this is, 1, 2, and then 3, then the subdivision of wave 3 could look like this. You get a 1, 2, and then you get like a 3 down here, 4, and then 5. So it'd actually be more like this. Okay, so you get 1, 2, and then, very strong third wave. This may carry us down here closer to this guy. And then a little bit of a rebound in 4, and then 5, and then you get another 4, and then 5. So this would still be quite bearish. If this is a triangle, then what this means is that it's a little more advanced than what I thought, and that the wave 1 is really over here. I know this may seem a little confusing at first, so this would be like a 1, 2, and then, this would be the end of wave 3 here, right? So it just means that this trend would be a little more advanced than what I was anticipating. So for right now, because wave 3s are excellent waves to trade, looking short pound dollar, and if it continues to pay off to the downside, is a decent trade to be in. But if we start to see a rebound that gets back up here into this consolidation zone, then what that suggests is that this wave 3 is actually ending right here, and that this wave 1 was really over here. So it just means we were off by 1 wave. Okay. It'd still be bearish. So even if wave 3, was about to end, this is still a bearish count. It just means we're going to get a little bit of a rebound back up into this congestion, and then prices would give us another jolt lower. So we still have a setup coming. As far as, if this is something, if you're not in a trade now, is this something that I would consider shorting from these levels? Probably not. I would be looking for an increase in price, or be looking for a bit of a rebound to use that strength to sell into in order to improve that risk-reward ratio back to my side. And that's the thing. Just entering short right now, the risk-reward ratio is going to be skewed a little bit. So it's going to be difficult to enter into a trade that's going to provide the payoff. Let's see. Let's move on over into U.S. equities. They were really, given some fits here earlier today or over the last couple of hours. So again, I wanted to leave some of the markings out here from Tuesday. And so the analysis, what we were talking about on Tuesday was, I think there's going to be, some heavy resistance showing up in this gray box, and that prices may come up into this gray box, and work itself lower. I said, ideally, I would love to see prices come down here into this green box. Now, how it gets there, I didn't know how it was going to get there. It tried to do a couple of fake outs to the upside, but we finally got down here into this green box. Okay, so let me get this out of the way. Now, once we got down to this green box, as you can tell by my blue arrow here, I was saying, hey, I wouldn't be surprised if we had a little bit of a fake break lower and then rallied higher. That is still possible. At the end of the day, S&P 500 and Nasdaq, they're just hot messes right now. Not real clear patterns. So I'm going to zoom out a little bit so we can try to get a better sense of what's going on, bigger picture, try to find some hotter zones. The good news is by coming down here into this green box, this is a decent support zone. And so as you can tell, prices for the last 2 hours have been oscillating up and down through this zone. It's trying to digest and figure out what it's going to do here. If it breaks down, or one pattern that I'm looking at is that we have an impulse or a motive rally to the upside. So this is a wave 1. After wave 1, we're looking for a wave 2. And so right now, looking at this as being a double 3, so a WXY, so ABC wave W, and then we would get, you know, some type of, you know, another ABC lower, and this is just a mess of an ABC lower. So I can't really get a good, you know, read on what, you know, what this pattern is. But one thing that we can do to just zoom out and give it a better look here is we throw Fibonacci retracement levels out here on our wave 1. So the top, even though price had extended beyond this top of wave 1, this is where we're anticipating the end to wave 1 right now. And so based on this, we've got a 50% retracement coming right inside this green box. The 618 is down here near 7,400. So that's why I mentioned, like, look, if we get a little bit of a dip below this green box, we've got the 618 of this impulse down here near 7,400. If 7,400 doesn't hold, then I think this entire advance is at risk, and we may see a retest down here to 7,300. So the way I'm looking at this is that this, you know, between now and 7,400 is going to be a zone that's going to, the market's going to begin to shift its hand to me. Are we looking at a bullish rebound developing? I'd want to see, just like in gold and silver, I'd want to see some of that bullish juice appear. Those, you know, some green candles appear, you know, stop and arrest this decline that's been taking place. But if this thing just keeps slicing lower, does not draft any long wicks to the downside, then I think below 7,400, I think we're going to revisit 7,300. So, you know, the models, you know, that I'm looking at here is that, you know, maybe it comes down a little bit, moves higher, or, you know, maybe it just slices through there and then works down to 7,300. So this is a hot spot, want to pay attention to. So a hot spot on the chart, you may hear me use that term a few times. Hotspot just simply means something's about to give. It's like you're playing tug of war. You know, the bulls and the bears are playing tug of war with a rope, and somebody's about to get slung into the mud in that mud pit in the middle. And so as this tug of war develops, you know, if it begins to rally, then that suggests that the bulls are winning and the bears are about to get, you know, slung into the mud. If this just continues to slice through here, then that suggests that the bears are winning, and we may have a bit of a short setup down here to these lows. There would be a little bit of a potential hesitation, you know, if it were to work itself lower. There would be a little bit of a hesitation here. You got the 786 level and this wick low appearing, so it would not be, you know, clear skies, blue sailing, smooth sailing. It may find a little bit of a hesitation here, but I think if it breaks below this 618, I think it's working its way down to below 7,300 over time. You know, taking a look at these daily candles here, you can tell today's candle is just a monster compared to what we've seen over the last couple of days. The current day midpoint is all the way up here at 74.60. So in order to be comfortable that the pressures to the downside are relieved, we'd need to see this current day, you know, the 74.60 level taken out and held to the upside. So, you know, but it's not a great place to go short either, because we're down here near a potential support zone. So we could get a bounce that produces a rally above the current day midpoint. You know, we just don't know, and we don't have the best of risk reward ratios, or we don't have a grade A trade here. This would be more of kind of a grade B, grade C type of thing, to where you could go long. We could set our risk, you know, below the 7,400, but it could just simply rally up near this midpoint and then get rejected again. So there's a decent risk reward ratio, but we just don't know if it's going to rally. It hasn't given us enough evidence that it's ready to rally yet. Yeah, appreciate you, Charlie, for, you know, sharing the link, you know, with your buddy. By all means, anybody else too. The 1 day candles, yeah. So what this is, So we're looking at a 1 hour chart. Charlie's question is, explain, this over here, these 1 day candles. And so the candles to the left is based on the time frame of the chart. So you can see my watermark back here. It's a 1 hour candle. Well, what this is to the right, these are the daily candles. But instead of, going back and forth, doing multi-time frame analysis and going back and forth between the 1 hour, and then, so here's the daily chart. Oops. Okay, so you can kind of see, here's your last 3 daily candles, which kind of looks like that. They're a little bit fatter, but so instead of swinging back and forth between, the various time frames and doing that multi-time frame analysis, I just have these daily candles projected on the 1 hour chart just to help the multi-time frame analysis go a lot quicker because it's all sitting right here. And then this is just another, indicator that takes the high and the low of the current daily candle, and it just takes 50% of it, draws a line. And then this one takes the high and low of the previous day candle, and it just takes the 50% mark of that and draws a line. So it just helps, those are things that are unrelated to Elliott Wave, but just from a pure market structure standpoint, it can help, make the analysis a little bit quicker, a little bit easier. Yeah, good question. Yeah, so Eamon, asking about, I hope you had a dedicated sponsored account with you so I can reactivate it. Yeah, so we've got, this is with FXIFY. So if you're interested, by all means, you go out to their website. Whether you're trading CFDs or futures, FXIFY has them both. So yeah, if anybody's interested in futures, by the way, I can also show some of the price fees for futures as well. Before moving on to Nasdaq, one other thing I want to look at here on the US 500. So right now, yeah, so this candle right here, I do keep an eye on. Let me zoom in a lot. Okay, so this candle right here is, so the cash market for the S&P 500 started trading. The first 30 minutes of the cash session was this candle. And so this live stream, I purposely started this live stream at 10 a.m. Eastern. So that's 9:30 a.m. Eastern is when this candle develops. What I've found is when I'm making trades in the market during that first 30 minutes, especially, when you're talking about US equities, man, it tears me up. And so I've just learned over time that it's best to just wait for that first 30 minutes of the cash session to develop, let the volatility do its thing. And then from there, we'll see what trends develop. And so I just wanted to highlight this because this is a great example where prices were just digging lower, digging lower, digging lower. The cash session opens, gets really volatile for 30 minutes. And then here we are. We haven't even broken the high or the low, or it looks like we might be getting ready to break the low, but we have not broken the high or the low of that opening 30 minutes. And so that's not unusual for that to happen. So if you find yourself getting, tossed around like you're a pair of socks in the washing machine, if you find yourself getting tossed around, check out what time it is if you're trading the S&P 500 or Nasdaq, because you may be getting, messed up within that first 30 minutes of the cash session. So in this case, now that I look at this, there is a strategy, an opening range breakout strategy. There's a lot of variations of it. It's as old as, it's as old as trading. I mean, it's been around for decades. Basically, you mark off the opening the price range of the opening of the cash markets, and then you trade a breakout on it. Now there's some differences, you know, hey, do you look at the first 5 minutes? Is it the first 15 minutes? Is it the first 30 minutes? Is it the first 60 minutes? So there's a lot of variations of it. I tend to lean towards the first 30 minutes. And so if we did get a breakdown below this low, I might be interested. Let's set this up real quick. So the stop loss would go at the 50% mark of the range, just to set a tighter stop loss. So that stop loss would be, you know, about 74.36. So you're looking at about 20 S&P points, and then it would target 20 S&P points to the downside. So that would be about 73.95. So that would take you down to about right here for a target. So even though you have 1 unit or 20 S&P points to the top inside the range, and then you're targeting 20 S&P points outside of the target range, by the time you enter into it, it ends up being less than a 1-to-1 risk-reward ratio. So that is the downside of this strategy, is that it is by design meant to create a higher win ratio, but your average winner versus your average loser, when it does lose, your losers are going to be on average larger than your winners, because by the time you enter in down here, instead of being 1-to-1, you're now looking at maybe like 1 to 0.6. But it still has not broken out yet to the downside. Okay, back here on Nasdaq. Awesome, Charlie. Yeah, great. Yeah, so it is an indicator. This is a custom indicator, and then this is a custom indicator as well. So Nasdaq is similar, obviously, to S&P 500. Nasdaq looks weaker, in my opinion. I'd been bullish Nasdaq, thinking this was a bullish triangle, right? So what I was saying earlier about triangles, the trend going into the triangle would be the trend coming out of the triangle. And so I was looking at this big structure right here as a bullish triangle. And then this is an example of how, there's analyst error involved when you're dealing with Elliott Wave. Like, even though, we're looking at these patterns and these patterns have certain structures and rules and guidelines to them, it's deductive. We're just trying to see what looks the best. And there's more than one option available. And the one we pick might not be the one that actually develops. And so in this case, because prices broke down into a new low right here below this low, this gives me a suggestion. Well, two things. Because that broke down to a new low, and because this rally just doesn't look to have any motive structure to it. So motive means it's in the direction of the trend. Because this doesn't have any upward trend direction characteristics, then this suggests to me that the next move is probably going to be to press this low. And so for this to be working itself to the downside, it's moved below this low. Basically, it has this wick left. Nasdaq might be a decent one to consider looking for a short trade, at least to work it down. If it's an intraday perspective, at least to work it down here to this low. So let's just check out a 15-minute chart real quick, see what we've got going on. You got your current day midpoint up here. So as long as we're below this level, this may be, like I said, pressurized to the downside. So just at the current price levels, even up from that high, my eyes are bad. I can't really see this low here. Okay. So from there to there, it's about a 1-to-1. So it's kind of an risk reward ratio. If this were to be taken, I would definitely look at a smaller trade size Wouldn't do anything crazy on this, but I think running this down here to retest this low, you know, maybe let's see if we got any structure. Yeah, I think this right here looks like it's an impulse pattern, a bearish impulse, and it looks like it may be about to end. Wouldn't say that with super high confidence. I would give it maybe a, you know, maybe a 60% chance it's about to end. And from there we may get a rebound back up into this level, and then that may reset it. So if we had a rebound up here into that level, that might that would produce a better risk reward ratio. I'd consider shorting Nasdaq up here near this level, stop loss up above this midday, and then targeting the lows down here. But yeah, it looks like it's taken off here. Keep an eye on this RSI. It may diverge, even though it's creating a lower low. If it starts to diverge here, that's very, very common behavior between a wave 3 and 5. And so what this may be doing is something like this. So it's doing a little wave 5 right now. This is the wave 3 low. And oftentimes wave 3 is your peak extreme on RSI. So, I mean, I don't know what's going to get in its way here to stop this decline, but it's just moved too far for me to, you know, be interested in doing anything right now. So maybe it is. Maybe it's just gonna, you know, take the A train down here to this low. Yeah, I agree with you, basketball. I mean, as much as I'd love to, you know, just to jump in and grab a little bit of something. These are the kinds of trades I've done a million times. I'm sure you probably have done a million times too, where you jump into something, you know, just because you see it moving, that FOMO kicks in. You know, you're like, oh man, I knew it was going to go down, and so you just jump in. You think, I'll just pick up a little bit along the way, and then it just seems like the market sure baits you into buying or selling the bottom tick, and so having done that many times, you know, just learned to trained myself, I guess, to just try to chill out, wait till tomorrow, you know, wait for a grade A setup, wait for something better to develop. Let's go back and check back on gold here. So we were talking about earlier. There we go. Okay, excellent. You know what? Gold, like we were saying earlier in this hour, like, man, I'd like to see gold put in something, you know, bullish here and overtake at least a good portion, you know, more than half of this. And so we're 7 minutes from this, you know, from the top of the hour, from this hourly candle finishing. And this is looking really good. So I'm feeling better about gold working itself up here to 40.85. Silver was also going to be in a similar boat. It was going to run into a little bit of resistance here. I mean, silver, like, this is a really strong low. I feel really good about this low right here. So silver, we're going to do something on either gold or silver. Just I'm deciding here in real time which one. This is you know, I think this is going to be a really strong low here in silver. So if we wanted to ride this over a longer period of time, I would feel better about, I mean, I'd feel decent about both of them. This is a decent level on gold as well. It's still well below its midpoint. Yeah, both of them are still well below their midpoints. Probably take a look here at gold. We'll probably look at this on a 2-lot structure. You know, first lot, we'll just take it up here to, use a stop loss just below this recent low, and then just write it up here to the 38% retracement level. So basically it'd be bouncing between the 618 and the 38. So that's a little bit less than a 1-to-2 risk reward ratio. So that'll be one of the lots, what we look at. And then the second lot, probably what I would do is use a conservative stop loss down here, and then probably leave the target open-ended, because if this does start to take off to the upside, I mean, there'd be a lot of upside potential here. So basically it's like two trades on the same thing, looking at it from two different perspectives. So if we were to walk through how this works, now again, don't know for sure if these are going to work out. This is just based on the analysis, thinking through it in real time, and just showing somebody how they might consider sizing up some of these, because I know a lot of traders, when it comes to going out and placing trades, they see a bullish pattern and they're like, oh man, and they risk way too much on it. And you got to think about your account as a checking account. Your bank account that you've got lots of bills you need to pay. You got your electricity, you got your cable, you got food and gas for the car, all these types of things. So you can't spend all of your money on just the electricity. You can't spend all your money on the food, because if you spend all your money on your food, you wouldn't have electricity to heat it up in the microwave or on your electric stove. So you got to spread these out, just like your trades. You need to spread them out and not put them all into one bucket, just one trade. Afford yourself the opportunity so that you can lose on a handful of trades, because someday, if you haven't already, you will lose on a lot of trades in a row. So for those that are relatively new to trading, so whether you're trading your own account or a prop account, usually within a prop account, there's a daily loss, max daily loss, or max drawdown. And so what you want to do is you want to take, and that'll be like your checking account. You want to take that as your checking account, divide it into a certain number of buckets, a certain number of trades. And I would suggest at least 10, maybe even up to 20. And so what that means is if you have let's just say a $3,000 drawdown, then what that means is if you divide it by 10, you want to risk $300 on each trade. And what that means is that if you were to lose 10 trades in a row, that's when you would hit your max drawdown. If you don't lose 10 times in a row, that means your account's still active and you'll be able to trade it for the next day. And oftentimes that's what we want to do. Sometimes it's just surviving to the next day until you get a grade A setup. So these out here, I mean, they're not necessarily grade A, but they're okay. You just don't want to go crazy on the trade size. That's the difference. Another way to look at it is trading is like a three-legged stool. So let me go ahead and get this going, and then we'll come back and we'll talk about the three-legged stool here. So what I would do is I'd be looking to go long. And so this is a $100 account, a $100,000 account. So I'd be looking at a risk down here at about 40.35. And so if you're not sure how much you want to trade, or how big of a size you want to trade, I always size it down to the smallest number. So if you're not familiar with like what the price per point is, size it down to the smallest number. If I want to risk about $300, then each 0.01 is about $23. And so therefore, if I did about 14, simple in the head math, that gets me a little bit more than 300. So right here at 13, it gets me to $300. And actually 12 would be a little more accurate. And then I'm going to target up here at about 40.84. So I like putting the price targets just above and just below the risk and the take profit levels in case it comes a little bit short. So as you can see, it's just slightly better than a 1-to-1 down here. So risking 275 to potentially make 310. Okay. And then if we're going to look at this from a longer term perspective, again, I would place a risk level down here. So this next one, we would I would not expect to happen overnight. So this one, you're going to need to be mindful of which carrier you're using, because this would be held for several days. You want to be mindful of the swap rates that they may be charging you. And some companies will go out and they'll charge you exorbitant fees for holding trades overnight. And if you're just trading intraday, you don't have those swap fees. But if you hold them overnight, you have them. And so with FXIFY, they are reasonable. But there are some carriers out there that it's an arm and a leg. And so you don't want to hold them overnight with those other carriers. But with FXIFY, it's okay. So we're going to go ahead and look at this from a longer term perspective. And we're just going to do another lot here, or another trade, if you will. So I'm going to come back here, do the 0-1. And the stop loss would be down here. We'll just call it 39.55. Okay. So in this case, a 0.01 down to that stop loss is about $100. So if I do 0.03, that'll get me about $300. And then we're going to keep the target open because this may be significantly higher. This could be, 43, 44, 45, maybe even up into the 5s over the long run, depending on which of these blue arrows develops, right? But there is a potential that we may get stopped out on this too. So, and then if for some reason we could profit on the first trade, and we could come down and perhaps get stopped out on the second trade, and we would be basically netting 0 on the combination of the two trades. But I think the potential for this second one to get stopped out, I think is relatively low. It's not 0. There still is a chance that we could be wrong and that we could get stopped out on that second trade. I think it's relatively low. And so therefore, I think that second trade, should be good over the long run. It just depends what happens between, over the next several days. How does this develop? But it looks like, it's trying to get out of the batter's box clean here to the upside. All right, let's see here. Yeah, so yeah, that first one, would take it back up to the current candle midday. So it could struggle on its way up there, but if it makes it up here to this current level and then starts to take off, basically, we've gotten a little slice out of the market. If it takes off, great. But again, we never know what's going to happen. There's always a risk that these could, move completely in the opposite direction that we're expecting. If prices do break down below this low, I mean, there's other patterns that we'll look at, but it'd have to plow through a lot of support in order to get there. So I think over the long run, this one's looking okay. All right, so we will be back here. We're reaching the end of the time here in the webinar room. So we will be back here next Tuesday and next Thursday. So this will be 10 a.m. New York time. So we hope to see you back then. Until then, best of luck in your trading. Bring your friends, and we'll see what the market wants to develop and wants to give us and talk about on Tuesday's live stream. So y'all have a fantastic weekend. Take care. We'll talk to you soon. All right. Bye now.